Hey guys, this is the Investment Venturer, and welcome to the Investor Next Door podcast. Today we'll be diving into sustainable investing. I should let you guys know that anything said on this podcast should be used for information and entertainment purposes only. This is not investment advice, and I do not recommend diving into any project or trying any strategy without doing your own research first. Sustainable investing, also known as responsible investing, ethical investing, or ESG investing, is a strategy that considers environmental, social, and governance (ESG) factors alongside traditional financial analysis when making investment decisions. Here's a comprehensive deep dive into the concept, definition, and philosophy. At its core, sustainable investing aims to generate long-term financial returns while also having a positive societal or environmental impact. This approach assumes that companies addressing ESG issues are better positioned for long-term success and risk mitigation. The ESG framework. E equals environmental. Factors related to how a company impacts the planet, climate change policies, carbon footprint, waste and water management, renewable energy use, biodiversity and land use. S equals social. How a company manages relationships with employees, suppliers, customers, and communities, labor standards, diversity, equity, and inclusion, DEI, human rights, community impact, consumer protection. G equals governance. Internal practices and policies that guide a company's leadership, board diversity and independence, executive compensation, ethics and transparency, shareholder rights, anti-corruption measures, types of sustainable investing strategies. Environmental, social, and governance integration. Incorporating ESG risks and opportunities into fundamental analysis, widely used by institutional investors. Avoiding sectors or companies based on ethical criteria, e.g., tobacco, weapons, fossil fuels. Positive screening. Investing in companies that score well on ESG metrics relative to their peers. Thematic investing. Focused on long-term sustainability themes like clean energy, electric vehicles, sustainable agriculture, water scarcity. Impact investing. Targeting investments that have measurable positive social or environmental outcomes, e.g., microfinance, affordable housing. Shareholder engagement. Using ownership power to influence corporate behavior, proxy voting, activism. Performance and risk. Excel. Performance. Numerous studies suggest ESG integrated portfolios can perform on par or better than conventional portfolios over the long term. ESG may reduce downside risk by avoiding companies with poor risk management, e.g., oil spills, data breaches, scandals. Risks. Greenwashing, companies or funds exaggerating ESG claims. Data inconsistency, ESG ratings vary across providers. Short-term underperformance, ESG constraints may limit diversification. Global trends and regulation. Boomi. Momentum. EU Sustainable Finance Disclosure. Regulation, SFDR. Canada's Climate Disclosure Requirements. USSEC ESG proposal for fund disclosures. Growing interest from millennials and Gen Z. Major institutional investors, BlackRock, Vanguard, CPPIB, integrating ESG. Tools and ESG metrics. Excel. Common ESG, ratings providers, MSCI ESG ratings, Sustainalytics, Morningstar, ISS ESG, Refinitiv, Bloomberg ESG. Environmental, social, and governance metrics examples. Carbon intensity, tons of CO2 per revenue. Board gender diversity percent, CEO pay ratio, ESG controversies count, sustainable investment vehicles, ESG mutual funds and ETFs. For example, ticker symbol XESG, ticker symbol ESGV, ticker symbol ICLN, ticker symbol VFTAX. Green bonds, fixed income used to fund eco-projects, sustainability-linked loans, interest rates tied to ESG targets, social impact funds, funds dedicated to education, healthcare, etc. Criticisms and challenges. Lack of standardization in ESG definitions and metrics. Some argue fiduciary duty may conflict with ESG constraints. Greenwashing concerns make due diligence critical. ESG ratings often contradict between agencies. The future of sustainable investing. Enhanced regulatory oversight. Rise of AI and big data for ESG analysis. Increased climate risk disclosure. Blurring lines between sustainable and mainstream investing. Focus on just transition, supporting workers in sustainability shifts. Resources for further learning. Books. Principles for Responsible Investment, UNPRI. Sustainable Investing, Revolutions in Theory and Practice, Herman Brill, Georg Kell. Beat the Bank by Larry Bates, Canadian perspective touches on fund quality. Computers. Morningstar Sustainability Ratings, MSCI ESG Fund Ratings, Arabesque S-Ray, Sustainalytics ESG Risk Rating. Now let's compare sustainable investing and traditional investing, covering key differences, overlaps, and how each approach impacts returns, risk, and values. Core philosophy. Sustainable investing seeks to generate financial returns while also considering environmental, social, and governance (ESG) factors. The idea is to support companies that are responsible stewards of the planet and society, and to avoid those that could cause harm or carry hidden long-term risks, like pollution or human rights abuses. Traditional investing, on the other hand, focuses purely on maximizing financial returns. Investment decisions are made based on financial fundamentals, like earnings growth, valuation, and market trends, without considering a company's ESG profile. What factors are considered? In sustainable investing, you still analyze a company's financial health, but you also weigh ESG issues, for example, how much carbon a company emits, whether it treats workers fairly, how transparent and ethical its leadership is. Traditional investing generally ignores those factors unless they directly affect profits. The focus remains on revenue growth, margins, competitive positioning, and market dynamics. How investments are chosen. Sustainable investors may exclude certain sectors, like fossil fuels or tobacco, favor companies with high ESG ratings, or invest thematically in areas like clean energy or sustainable agriculture. Traditional investors will choose companies or funds based on expected returns, regardless of what industry they're in or their ESG behavior. A traditional investor might own a coal company if it's expected to be profitable. Performance and risk. Sustainable investing is sometimes thought to underperform, but in practice, ESG-aligned portfolios often do just as well or better than traditional ones, especially over the long term. This is because companies with strong ESG practices may be more resilient, better governed, and less exposed to reputational or regulatory risks. Traditional investing may offer more short-term opportunities, especially in sectors that are excluded by ESG mandates. However, ignoring ESG risks can expose portfolios to unseen vulnerabilities such as climate risk, legal battles, or supply chain disruptions. 5. Who typically uses each approach? Sustainable investing is popular with younger investors, institutions with mandates to invest responsibly, like pension funds, Investors who care about aligning their money with their values. Traditional investing appeals to investors focused solely on financial performance, active traders and value investors, those who prefer broad exposure through standard index funds. Real-world example. Let's say you're considering buying a U.S. stock index fund. A traditional investor might choose SPY, tracks the S&P 500, which includes companies regardless of ESG behavior. A sustainable investor might instead choose ESGV, which also tracks large U.S. companies but excludes those that don't meet certain ESG standards. Both funds could include companies like Apple or Microsoft, but ESGV might screen out oil producers, weapons manufacturers, or companies with poor labor practices. Conclusion: the key difference comes down to intent and values. Sustainable investing aims to build a portfolio that performs financially and reflects ethical priorities. Traditional investing sticks to financial fundamentals without considering the broader impact. That said, the line between the two is blurring. Many traditional investors now recognize that ESG issues can materially affect long-term performance, so sustainable investing is increasingly becoming part of mainstream investing. That's all for today, folks. Thank you for listening to my podcast. Be sure to subscribe to the Investor Next Door podcast on your favorite podcast listener. If you're watching on YouTube, be sure to like and subscribe for future episodes. Follow me on social media to stay updated. Twitter X @InvestNDPod. Instagram @InvestNDPod. Share this episode with your friends if you've learned something valuable from this podcast, and I'll see you guys next.